Let's take a good look and compare both cash flow and revenue flow. Revenue flow, in its simplest form, is how and when revenue comes into your company. So any sale that you make should make a difference in your revenue flow at some point in time. If you invoice all of your clients, then your revenue flow is dependent on your customers' timeliness in paying their bills. So the work you do this month does not necessarily reflect revenues coming into your company this month. It could be next month or 2 months or 3 months or maybe 4 months or maybe never. Let's take a quick snapshot look at a 6-month period of time for revenue flows for a typical PI business with an average of $100,000 in revenue that carries accounts receivable, which is something I recommend to never or very rarely ever do. The assumptions in play here are 40% of income goes to operational expenses. Then for receivables, we collect 25% of the current month receivables plus 25% each of the past 3-month receivables, which means all of our receivables get paid within a 4-month period of time. Now, some of these may be on net 60, some net 90, some net 120, but I will do an average for simple math. We will also assume your take-home pay comes out of the net income of the business, which is the case for most LLCs out there. This video is sponsored by OREP Insurance and Working PI Magazine. OREP is a leading provider of private investigator liability insurance. Visit orep.org for a quote today. So the good news is everything after the bills are paid is yours to keep. Looking at our model, we start the year off slow, just like most Januaries for most PIs. Winter is tough to get through. We are starting the year off with $4,000 in billable work for January, then $5,000 in February. Then we get a huge couple of months in March and April, $12,000 and $13,000, a slight dip, but still very good workloads in May. In June, $9,000 and $7,000. Not too bad of a picture, right? This reflects $100,000 in annual sales, which is a good place to be. We see, even with carrying receivables, we have a $23,000 6-month positive revenue stream. However, if we look at the revenue stream where we collect 100% on retainer up front, thus carrying no receivables, after 6 months, our positive revenue stream after paying the bills is $30,000. In other words, folks, you have $7,000 more dollars in usable earnings for the 6-month period of time. And remember, every dollar of profit is your income as an LLC. Okay, for simplicity's sake, I will assume 25% each month is received on our current work, 25% of each of the past 3 months billed work is received each month. We will also assume we started the year with $3,000 in the bank, and you always want to make sure that you have some starting capital in the bank each year. Now in our model, we see a new line added that shows our month-to-month cash flow for our PI business. This is taking our end-of-the-month cash on-hand balance in our account and adding in revenues received for that month. Again, if you compare the model where we allow for receivables, you see our cash balance before we ever pay ourselves is $26,000 in June, 6 months into the year. However, if we look at the same scenario where we receive 100% retainer and carry no receivables, our 6-month cash total is $33,000 or $6,000 higher or 23%. Now, what does that mean? Great question. Obviously, having $26,000 in the bank after 6 months of business is nothing to sneeze at. And obviously, having $33,000 is even better. But we really need to make sure we consider all of the factors of our business before we draw any conclusions. Now, why are you in business? What makes you get up every morning and keep the grind going day after day? What is the primary purpose for being in business? Well, if you are like most business owners, then you're working to make an income. So we need to assume that you get some level of pay out of this. Remember, the numbers we have seen thus far is net after bills, not considering our pay. As an LLC, you don't really get a paycheck usually. You will take owner draws from the business as needed. For me, I get a regular payment every month from the business. However, all of the profit of my business is my actual income, so my tax calculations are based on the entirety of profits from the company. This gets a bit complicated. It's a little bit off topic, and it would be a good discussion for you to have with your tax accountant. Now let's take a deep dive and look at the real cash flow projections after we get our pay. For our assumptions, we will assume our take-home pay at $50,000 a year. This take-home then calculates out to $4,167 a month. So let's look at our cash flow after we get our paycheck. First, the model where we carry our accounts receivables. Remember, not all of our work is being billed out. We are assuming 25% of each month's work is paid up front. Then we receive 25% for the past 3 months receivables, so every account is paid in full within 4 months. Some may be net 30, some may be net 60, some net 90, some net 120. Now here is that new chart. We now have a new line called cash flow after salary. This line shows all of our cash on hand after we pay ourselves each month. You will quickly notice that it does not take long for us to get into the red. After we pay ourselves in January, we have a little over $1,000. But after February, we are minus about $700, and March is worse, over $3,400 in the red, with April over $4,200 in the red, a slight improvement in May, but still a loss of around $2,200, and finally in the black after 6 months of operation, but less than $1,000 in the bank. When we compare this to the chart, which assumes 100% paid up front, we still see some challenges, but no months in the red. February, we dipped down to $66 in the bank, which would be hugely concerning for me if my operations account had only $66. But it quickly has a rebound in March and continues to improve after that. Here is the crux of it all, folks. This is why I have seen so many a PI come and go in the past. This can seem insurmountable to some people. To be working and you get no pay for 6 months, this is where many people either give up or they go out and they get a business loan. Getting a loan then introduces even bigger challenges, as now you have a new payment line to add to your expenses and you're accruing interest as well, both of which compound the problem and keep the company spinning downward out of control. Folks, better business decisions like working on retainer, not receivables, is one way to help ensure success for your PI business. Now, the big secret here, given the scenario we looked at today, I would not pay myself that $4,167 a month. I would make it something like $3,500 to help ensure I stay afloat. At that rate, the lowest my cash balance ever gets is $1,400 and gives me a good balance of $12,000 after 6 months. I also always recommend that you always try to start the year with 3 to 6 months operational capital. So that means enough money in the bank to keep the business operational and paying yourself even if no income comes in. Now, I know you can't start right away with that kind of money. It may take a few years of building that stockpile. Paying yourself a little less, being a little more frugal, is well worth it in the long run. In this scenario, 100% retainer, it would take 2 to 3 years to have cash in the bank to cover 6 months of operational expenses and 6 months of owner draw. And if you can make it to 3-year mark, folks, you can make it to the 10-year mark.